Hello everyone, welcome. Today we will examine in detail one of the most legendary names in the stock market world, Mark Minervini, and his unique technical analysis approach that enabled him to achieve million-dollar returns. If you are ready, let's take a deep journey into the mind and strategy of a champion. When you step into the world of Mark Minervini, you actually enter the mind of not just an investor, but a risk engineer and an architect of discipline. Minervini is much more than a classic technical analyst. He is a structural trader. His approach is not about reading random lines on charts, but about analyzing the institutional footprints behind those lines, the accumulation processes of giant funds, and mathematical probabilities with the precision of a surgeon. Today, we will delve into the technical details of the strategy of this market wizard, who rose from poverty to achieve a staggering return of 3,500% in 5 years. At the foundation of Minervini's success lies a system he calls SEPA, or Specific Entry Point Analysis. This system does not see technical analysis as a magic wand on its own. It positions it as a confirmation and timing mechanism. SEPA has 5 fundamental pillars: fundamental momentum, technical structure, institutional support, market trend, and most importantly, the tight risk entry point. When Minervini looks at a stock, he first checks whether the stock has the wind at its back. If a company's earnings growth is not accelerating, if its sales are not increasing, or if the industry group it belongs to is not strengthening, the chart of that stock is merely an illusion for Minervini, no matter how beautiful it looks. In his philosophy, technical analysis is a trigger mechanism that turns the potential created by fundamental data into reality. At this point, the real task of technical analysis is to confirm that institutional money has started to enter that stock. Because no matter how good a company is, the price will not rise unless big funds move into a buying phase. According to Minervini, a technical structure without a solid foundation is like a building built on sand. It is destined to collapse at the slightest tremor. That is why he only takes the charts of stocks with a story and solid numbers seriously. Moving to the technical side, the actual concept that etched Minervini's name in stock market literature in golden letters is the volatility contraction pattern, or the VCP structure. Many amateur traders make a mistake by waiting for the price to rise rapidly. Minervini, on the other hand, waits for the price to tighten. VCP is the digestion and power accumulation period that a stock goes through before a major rise. Imagine it like this on a chart. The stock first makes a 25% correction, then tries to recover but reaches a shallower 12% drop again without passing the peak. Then comes a 6%, then perhaps a much smaller 3% pullback. This is what Minervini calls the drying up of supply. In every contraction, volume should decrease. The price should stretch like a spring, and sellers should completely withdraw from the market. Minervini calls this shallowing pullbacks. If the price movements on a stock chart are still very wide and irregular, that stock is not yet ripe, and institutional money has not yet taken control. Minervini enters the game when volatility narrows and risk is at a minimum, that is, when the pivot point is reached. These contraction zones are actually a cleanup phase where the big fish eliminate the small ones and impatient investors dispose of the stock. When this process is complete, the stock becomes ready to explode with even the slightest increase in demand. However, finding the squeeze alone is not enough. Minervini focuses obsessively on the concept of relative strength in his technical analysis. What we are talking about here is not the popular RSI indicator. It is the price-performance superiority shown by the stock compared to the index and other stocks. Minervini considers chasing cheap stocks as a gamble. He follows leader stocks that stay on their feet while the general market is experiencing a correction, falling only 2%, or staying horizontal while the index drops 10%. These stocks are the fortresses where giant funds and smart money take refuge when a storm breaks out in the market. When the market turns, these leaders are always the first and sharpest to jump. Minervini sees stocks close to their 52-week highs not as a danger, but as proof of strength. The philosophy of follow the leaders, leave the weak to the mercy of the market ensures that his capital is always invested in the most efficient horses. Relative strength is a quality control mechanism embedded within technical analysis. In this way, it becomes possible to filter out the noise across the general market and focus on the real potential. When we come to the moment of the transaction, that is, the critical breakout point, the breakout philosophy appears before us. But Minervini is not an ordinary breakout trader. He is a seeker of quality. For a breakout to occur, the pivot point of that narrow-risk VCP structure we mentioned must be exceeded. At the moment of the breakout, volume must explode, and the price must move up decisively. Minervini's real mastery is in his reaction after the transaction. If a stock does not show the expected momentum within a few days after the breakout, Minervini does not hope that maybe it will turn tomorrow. He accepts the mistake immediately. For him, a breakout should be like a tennis ball hitting the ground and bouncing up rapidly. If the stock stays there like an egg hitting the ground or slides down, there is no point in staying in that position. He calls this understanding the difference between a natural reaction and an abnormal movement. Technical analysis here tells you not only the entry point, but also whether the time to exit has come. In a correct breakout, the stock does not make you wait. It starts showing profit for you immediately. Right at this point, Minervini's most unshakable rule comes into play: risk first. Many investors start by dreaming, but Minervini starts with facts. When he looks at the chart, his first question is not "where will it go?" but "where am I wrong and where do I stop?" If a chart does not give him a clear, narrow, and mathematically logical stop point, he never enters that transaction, no matter how huge the potential seems. Technical analysis for him is not a key to wealth, but a risk management map. He says, "The market determines the upward direction. The only thing you can control is the downward direction." He is ruthless and emotionless about the stop. He sees small losses as a store's rent cost. However, a large loss means the store is burning down, and he never allows that. He usually applies a rigid stop margin varying between 5% and 8%, and in this way, he always keeps his capital ready for the next opportunity. He has a famous saying, "If you don't learn to embrace losses, the market will embrace you and suffocate you." Risk management for Minervini is not just a technical rule, but a survival instinct. On the money management and mathematics side, he takes the reality of compounding or compound return to a completely different dimension. Minervini reminds us of the most painful reality of trading with the example of Larry and Stewart. If there are deep pullbacks in your system, it is mathematically impossible for you to grow. A portfolio that experiences a 50% loss needs to gain 100% to return to its old place. To avoid falling into this mathematical abyss, Minervini uses the method we call step compounding. Instead of blindly increasing risk as he earns, he updates the capital base when certain safe profit thresholds are exceeded. He adjusts the position size according to the volatility of the stock. That is, the more aggressive the stock is, the smaller the position, and the more calm and controlled the stock is, the larger the position. This technical discipline prevents emotions from getting ahead of mathematics. He is also selective about portfolio concentration. Instead of dividing into dozens of stocks, he aims to achieve high returns by focusing on the best 4 or 5 leader stocks. Focus, for him, is the only way to maximize profit. Psychologically, Minervini has declared the hindsight trap, or the retrospective view trap, as the biggest enemy of his trading career. The price rising again after selling a stock infuriates many people, or deviates them from their plan. Minervini, on the other hand, focuses on the process. If he has done the right thing according to the data at the moment of the decision, he does not care what the result is. What matters is not the success in a single transaction, but the stable upward movement of the equity curve in the long run. He sees trading not as a hobby, but as a professional business. Every transaction is a business decision. Every stop is a business expense. If your costs are smaller than your profit, your business is in profit. This simple but unshakable logic protects him from emotional fluctuations. His transaction logs, which he keeps to analyze his own mistakes, are his greatest teacher. After every transaction, he constantly optimizes his system by asking, "What did I do right?" and "What could I have done better?" Ego never sits at Minervini's table. There are only discipline and data there. The real secret that made him a world champion is that he went through an unbalanced focus period. For a long period of his life, Minervini worked more than 14 hours a day, memorizing thousands of charts, patterns, and market cycles. His success is not a stroke of luck, but the product of obsessive work. He has no ego to be right. He has a discipline to make a profit. If the market conditions are not suitable, If those famous VCP structures are not forming, Minervini sees waiting in cash for months as professionalism, not a loss. Patience is the strongest weapon in his technical arsenal. He is as aggressive as a lion in a bull market, and as protective as a fortress in a bear market. He always remembers that the market is bigger than the ego, and never challenges the market, he only aligns with it. He has spread the principle of trend following in technical analysis to every area of his life. For Minervini, discipline is not a boring necessity, but the only way to freedom. In short, Mark Minervini's technical analysis is not a screen full of complex algorithms or incomprehensible indicators. It is the art of reading the balance of supply and demand in its purest form, detecting the squeeze with VCP, finding the strongest leader with relative strength, confirming the foundation with SEPA, and protecting the capital with risk first. These four fundamental pillars have made him one of the greatest traders in financial history. Minervini actually does not do technical analysis. He waits for those rare moments when the risk is smallest and the probability is highest, and when that moment comes, he acts without hesitation. The secret of his success is not making perfect predictions, but paying very small prices when he is wrong and riding huge profit waves on leader stocks when he is right. As we finish this comprehensive narration, the most important reality that should stay in your mind is this: technical analysis does not tell you the future, it tells you the probabilities and risks. Mark Minervini's 3,500% return is the victory of not just a chart-reading skill, but an unshakable discipline, a mathematical risk management, and a never-ending passion for learning. You cannot control the market, but you can always control your own risk. When you provide this discipline, technical analysis ceases to be a fortune-telling tool and turns into a professional roadmap that carries you to financial freedom. Real mastery is being able to reduce even the most complex charts to the simplest risk-reward equation. Discipline is not just a rule, it is the only reality that allows you to survive in the market. Thanks for listening. See you in the next episode.